Ethan gets a bonus. Ryan gets the exact same bonus. They both have $20,000 sitting in their bank account. They both have a car loan. They both want to build wealth. And they both think they're making the smarter choice. They're both wrong. Because one of them is focused on becoming debt-free. The other is focused on building investments. And when you actually run the numbers over the next 10 years, the answer isn't nearly as obvious as most financial gurus make it sound. Let's keep this fair. Ethan and Ryan are both 30 years old. They both earn $60,000 a year. They both have a $20,000 car loan at 6% interest. The monthly payment is about $386. They both receive a $20,000 work bonus. The only difference is what they do next. Ethan hates debt. The moment the bonus hits his account, he pays off the entire loan. Gone. No payments. No interest. No debt. Ryan does the exact opposite. Instead of paying off the loan, he invests the entire $20,000 into a total market index fund. He keeps making his normal monthly car payments. No stock picking. No trading. No crypto. Just a boring index fund. Day one feels like a huge victory for Ethan. His car is officially his. Nobody can repossess it. Nobody owns a piece of it. There isn't a single dollar of debt attached to it. For the first time in years, he feels financially free. Ryan feels the opposite. The loan still exists. The payments still exist. The interest still exists. His friends think he's making a mistake. Why keep debt when you already have enough money to eliminate it? That sounds irresponsible. And emotionally, Ethan seems like the obvious winner. But feelings and math are two very different things. Let's look at year one. Ethan's loan is gone. His old $386 payment has disappeared. In theory, that means he has an extra $386 every month available to invest. But that's not what happens. A few restaurant dinners, a new phone, a weekend trip, a few Amazon purchases. Nothing dramatic. But because the payment no longer exists, the money slowly gets absorbed into everyday life. Ryan still has the loan, but his $20,000 investment grows roughly 10%. By the end of year one, it's worth around $22,000. Not life-changing, not exciting. Most people wouldn't even notice the difference, but something important has started: compounding. The process that makes money grow on top of money. And at the beginning, it feels painfully slow. That's why most people underestimate it. By year three, Ethan still feels great. No debt, no loan, no payment, no financial stress. Psychologically, it's hard to put a value on that. There's something satisfying about knowing you owe nobody anything. But financially, the picture is becoming more complicated. Because paying off debt and building wealth are not the same thing. One removes a liability. The other creates an asset. Ryan's investment account has now grown to roughly $26,600. Meanwhile, his loan balance has fallen significantly through normal monthly payments. His investment is growing faster than his debt is costing him, and that's the entire reason his strategy has a chance of working. This is where most financial debates go wrong. People love saying things like, all debt is bad, but that's not actually true. A 25% credit card is very different from a 6% car loan. A payday loan is very different from a mortgage. The interest rate changes everything. Yet most people talk about debt as if every dollar borrowed is identical. It isn't. The payment is the number everyone focuses on. It's the number on the statement. The number that leaves your bank account every month. The number people complain about. What nobody talks about is opportunity cost. Every dollar used to eliminate low-interest debt is a dollar that can no longer be invested elsewhere. That doesn't automatically make investing better, but it means there's a trade-off, and trade-offs matter. By year 5, Ethan has completely forgotten about his old loan. Life moves on. The debt is ancient history, but the wealth he expected to magically appear never showed up, because eliminating debt doesn't automatically create wealth. It simply stops wealth from leaking out. Ryan's investment account is now worth roughly $32,000. His loan is nearly gone. And now, something interesting is happening. His investment gains are beginning to generate their own gains. The account is no longer growing, primarily because of the original investment. It's growing because the growth itself is creating more growth. That's the point where compounding starts accelerating, slowly at first, then faster. then surprisingly fast. But before we declare Ryan the winner, we need to talk about the hidden costs, because investing has risks that people love to ignore. The stock market doesn't move in a straight line. It never has, and it never will. Let's say Ryan started this strategy right before a major market crash. His $20,000 investment grows for a while, then suddenly drops 30%. Overnight, the account falls to roughly $14,000. The loan still exists. The payments still exist. The interest still exists. Nothing about the debt changes. Only the investment changes. And this is where many investors make a costly mistake. They panic. They sell. They convince themselves the strategy failed. Then months later, after the market recovers, they buy back in at higher prices. Exactly the opposite of what they should do. The market doesn't test your intelligence. It tests your patience. And patience is surprisingly rare. Ethan never had this problem. His return was guaranteed. Every dollar of interest he avoided was a guaranteed benefit. No crashes, no volatility, no scary headlines, no sleepless nights wondering whether the market will recover. That certainty has value. A lot of value. If I only showed you the benefits of investing, I'd be making the same mistake many finance influencers make. Debt freedom provides something a spreadsheet can't measure. Peace of mind. For some people, that peace of mind is worth more than a slightly higher return. But debt-free obsession has risks too. Some people spend years aggressively paying down every loan they have. Every extra dollar goes toward debt. Every bonus goes toward debt. Every tax refund goes toward debt. Eventually, they become debt-free. But then they look around and realize something uncomfortable. They spent years eliminating liabilities without building many assets. No significant investments. No retirement account growth. No meaningful compounding. They're debt-free, but they're not financially independent. Those are not the same thing. The goal isn't simply eliminating debt. The goal is building wealth. Debt reduction is one tool. Investing is another. Neither solves the entire problem by itself. Now let's fast forward to year 10. Ethan's debt-free car has been paid off for years. The loan is a distant memory. And that's a real accomplishment. He enjoyed the certainty. He enjoyed the peace of mind. He enjoyed knowing he owed nobody anything. Ryan's original $20,000 investment has grown to roughly $52,000, assuming average market returns, more than double the original amount. Meanwhile, the loan disappeared years ago through regular payments. The debt eventually ended. The investment kept growing, and that's the key difference. One decision created immediate relief. The other created long-term growth. This is the uncomfortable truth most people don't want to hear. The mathematically optimal decision and the emotionally comfortable decision are often different. Sometimes paying off debt is the best move. Sometimes investing is. It depends entirely on the numbers. A 25% credit card debt should probably be eliminated immediately. A low-interest loan creates a much harder decision, which brings us back to Ethan and Ryan. Ethan thought paying off debt automatically made him smarter. Ryan thought investing automatically made him smarter. Neither understood the full picture. The real winner wasn't the person who chose one side. The real winner was the person who understood the trade-offs. Because the biggest financial mistake isn't debt, and it isn't investing. The biggest mistake is making money decisions based entirely on emotion without ever running the math. And the next time someone tells you to always pay off debt first or always invest first, ask them one simple question. What's the interest rate? Because that single number changes everything. And in personal finance, the details people ignore are usually the details that cost them the most money.